The Fed just made their intentions crystal clear with how they plan to continue to fight inflation, even if it's at the cost of the economy and the housing market. We're already seeing housing transactions crash as a whole. We're seeing inventory starting to pile up, houses sitting on the market longer, as buyers are starting to just give up on today's housing market, and sellers just have very unrealistic expectations for their selling price. What's up, guys? It's James Allen, the Out-of-State Investor, and we have a lot to talk about today. Between the latest home sales report coming out, we got mortgage rates spiking back up again, demand is dissipating, and how the Fed's plans will only cause more pain to the housing market. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. Existing home sales reportedly fell for the 6th month in a row, dropping over 20% year over year, and even more alarming, dropping over 5.9% month over month from June to July. Housing transactions are starting to collapse as a whole, as we're starting to see buyers have much less confidence in today's housing market as they start to see housing prices decline nationwide. In addition to that, we're seeing sellers that are just unrealistic with their expectations of what they're able to sell their house for, still looking at comparables back 2 to 3 months back, thinking they can get the same pricing for their house. And contributing to it even further is the amount of buyers we're seeing that are backing out when they're already under contract on a house. We already saw the highest levels we've seen in a really long time. Over 16% of all buyers under contract are backing out of their contracts, and that just adds more supply to go back on the market when they pull out. Now, at the heart of this problem, when it comes to buyers, the biggest problem we're seeing come into play is housing affordability. People can just simply not afford to buy a house at today's levels when you factor in mortgage rates and home prices. The housing affordability currently is at the worst levels it's been at since 1989, over 30 years ago. Now, we thought things were starting to get better with affordability as we started to see early in the month of August, we saw mortgage rates starting to drop down significantly from around 6% all the way down to the low 5s. But now recently, in the past few weeks, we've started to see mortgage rates spiking back up to around 5.7, 5.8%. So that brings us back to this affordability crisis where home prices mixed with these high mortgage rates just price so many people out of the market. And that combined with the fact that many buyers are already aware of the price declines that are taking place nationwide, it's just causing more concern about the future of the housing market and taking more buyers out of it. In fact, we're seeing more evidence of this with the Mortgage Bankers Association publishing that we're at a 22-year low in mortgage applications. And as far as purchase applications go, we're currently down 1% week on week and 21% year over year. So we can see the demand is clearly falling. Inventory is also starting to pile up as we've seen it go from the levels of 7 weeks of supply earlier on in the year to now over 11 weeks of supply nationwide. And this is a big deal because, as we know in real estate, supply and demand play a huge role in the future of house prices either going up or going down. And as you see supply levels go up and you see demand go down, that's a clear indicator of future house price declines. In fact, these are really the highest levels of supply we've seen since the summer of 2020. Now, as the housing market continues to see more red flags, what you start to see is home builders start to get more nervous, and we're already starting to see evidence of this as it was reported recently, and we talked about this last week, that the home builder sentiment levels are at the lowest level since May of 2020. Home builders are nervous right now, and we're seeing evidence of that because according to Realtor.com, housing starts when they're building new houses, that is down 9.6% month on month. So just between June to July, we've already seen a decline of 9.6% in housing starts, taking the seasonally adjusted rate down from 1.6 million to 1.45 million. Now, these declines have been starting to take place ever since the Federal Reserve started to raise interest rates, and this is a big deal, and it matters to home builders because home builders have the responsibility to look ahead as their business is big on building houses but also selling to home buyers, and the health of the overall economy plays a huge role in their success in that. Now, when the Fed raises interest rates, they're doing it to slow down the economy, specifically right now in order to fight inflation, because inflation has gotten out of control. We're hitting over 40-year highs in inflation, and so a great way to do that and combat that inflation is by raising interest rates. Well, so far we've already raised interest rates over 4 times times in March, May, June, and July, and we anticipate to have another 3 rate hikes in September, November, and December of this year. So home builders see this and they understand that as a result of what they can expect to happen with the economy, that they need to slow down with the home building. And it's a good thing they've been doing that because they've already been seeing new home sales decline at a rapid rate. You see, if you thought existing home sales was bad, going down over 20% year over year, new home sales is down almost 30% year over year, with a drop of 12.6% just month over month from June to July. There's a lot of reason for buyers to be more nervous buying new construction versus existing homes, and a big reason for that is when it comes to new construction, you're essentially buying at the absolute top of the market. I mean, you're essentially overpaying for that property, creating a new comparable because all the homes built the years before that, they are not as new as that product, and so naturally you're creating a new comparable, a new high in terms of value of home prices. Now, in an upward trend market, it's generally not a big deal to buy new construction because especially if you can buy early on in the phases, phase 1, and then you get phase 2 released, which is generally a higher price, and then phase 3 released, that's even a higher price. So you start to have more comparables that will give you a little bit of safety net. However, when there's a housing market recession taking place, now there's a lot of danger because if you're buying at the top of the market, you could find yourself easily in instant negative equity. Now, speaking of recessions, an economic recession is looking more and more of a certainty as time goes by. We had Jerome Powell recently talking at his Jackson Hole speech in Wyoming about how he plans to stay extra aggressive. He doesn't want to repeat the mistakes that were made back in the late 70s, early 80s when they had inflation. They thought they had inflation under control, so they started to change their monetary policy to get a little less aggressive, and that ended up backfiring on them. So they do not want to make that mistake, so they plan to stay extra aggressive. Their target is that 2% inflation rate. Now, he mentioned at his speech that they must keep going until the job is done. Referring to inflation, of course, they want to tackle that problem before they shift gears on their monetary policy. And so this essentially sets the tone that the Federal Reserve has prioritized inflation over the worries and concern of inducing an economic recession. So if they stick to their plans of what they say they're going to do, I think it's very likely, it's almost a certainty that we're going to be inducing an economic recession, which means more pain for the housing market. Now, we also recently had student loan forgiveness announced. Now, this is going to consist of $10,000 of forgiveness per borrower with student loan, and this is federal student debt, and up to $20,000 if you received Pell Grants. Now, there is an income requirement with this. You do have to make less than $125,000 as a single taxpayer, or if you're a married household making less than $250,000. And so as a whole, they do expect this to cost a total of around $500 billion. So this was a very interesting move because on one hand, you have the Federal Reserve, in which their #1 priority is simply to tackle inflation. And while they're doing that, you have the administration over here putting out their student loan forgiveness, which just adds even more inflationary pressure. So that just simply means that we're going to have a longer road ahead in tackling this inflation in order to get to that target 2% rate, which means that we're likely going to have even more economic pain as a result. So we can expect to see more aggressive behavior in order to tackle this. That could be more rate hikes as far as the federal funds rate is concerned. But in addition to that, we've also seen the US 10-year Treasury starting to climb. It climbed over 3% recently, and we can definitely expect that to continue as the Fed continues to stay aggressive. Now, the question is just how high will the 10-year Treasury go? It's gotten as high as 3.5% so far. The reason why we care about how high the 10-year Treasury goes is the 10-year Treasury plays a huge role in mortgage rates. Typically, as the 10-year Treasury goes up, we start to see, as far as the rates of the 10-year Treasury, as that goes up, we start to see mortgage rates go up as well. So we've talked about mortgage rates spiking recently. Well, honestly, I believe that that is only going to continue throughout the rest of this year. The Fed has promised to offload a lot of its balance sheet, but the reality is so far it has not been living up to the expectations that it set forward. You see, they've been building up this massive balance sheet over the past several years, and now they have trillions of dollars on their balance sheet. So their plan was to start to offload this gradually, doing about $47.5 billion a month to start, and then gradually working their way up to about $90 billion a month after the first few months. Now, their plan was not to sell these treasury bonds, but to let them naturally mature at their own speed, and they estimated that over that time period, they would be able to let it go $47.5 billion to eventually $90 billion. Well, so far that has not been going anywhere close according to plan, and so as a result, are we going to start to see them become more aggressive to start to meet those expectations? And if they do, that could really start to raise rates on the 10-year treasury, which as a result will definitely play a role in mortgage rates going even higher by the end of the year. Now, so far we've already seen the median sales price decline over 6% from the peak. Now, I'm already expecting that number to get worse, but you have to wonder, if you have mortgage rates going from 5.7% all the way to as high as maybe 7%, what would that mean for housing affordability? What would that mean for the inventory that would start to pile up? And then house prices, how far would they start to decline? Could we be looking at a nationwide housing market collapse? Well, it's very possible, because housing affordability at that point would be absolutely insane. The levels we're at right now is already insane. Again, the highest level since 1989. So at 7%, you can only imagine what that would do to the housing market as a whole. So these are things we're going to have to continue to monitor. Again, it comes down to two things essentially. It's the Fed's monetary policy, which they're making it more and more clear at this point that they plan to stay aggressive, which means, again, more doom and gloom for the housing market. And secondly, what continues to happen with mortgage rates? Are they going to continue going up? Well, I've already told you that I believe that's definitely going to be the case, which if that happens and the Fed continues to stay aggressive, we can definitely anticipate some more severe house prices on a nationwide level. So with that said, I hope you guys enjoyed today's video, and if you appreciated it and gained some value from today's video, do me a favor and smash that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know in the comments below if you have any thoughts or questions, and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor, and if you enjoyed today's video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you guys on the next one.